I think we're good to go live. You?
Should I go?
Ready?
All right.
Yeah,
Okay.
are you ready?
At CFA Boston, we have a virtual class, data visualization with Microsoft Power BI, and that's 2 Fridays, starting on the 22nd. And then there's going to be a career chat, endowments and foundations. And then there's going to be on February 11th is going to be understanding the cannabis industry landscape, perspectives from investors, regulators, and entrepreneurs. And Cheech and Chong will be presenting that.
Are there going to be samples, Hugh?
Yeah, you got to go to Netta for that. And then pensions on the 17th, February 17th, pensions lessons learned from the pension crisis. And then on the 18th is 6 keys to confident advisors presentations. So anything from Quant University?
Yeah, so we're kicking off our winter school, and tomorrow we have a 90-minute workshop on generative quantum machine learning. Dr. Luis Serrano is going to be doing that workshop. It's 11:30 to 1, and I'll send you a note if anybody wants to join in. Of course, you're welcome. It's complimentary. And next week, there's another session on machine learning in finance, 10 things you need to know. It's again Wednesday at noon. So those are 2 events you're interested in.
Okay, are there any other announcements? Any software to sell? Okay, Thomas Waiki is the Chief Investment Officer at PyMC Labs, a Bayesian consultancy. Prior to that, Thomas was VP of Data Science at Quantopian, where he used probabilistic programming and machine learning to help build the world's first crowdsourced hedge fund. Among other open source projects, he was involved in the development of PyMC3, a probabilistic programming framework. He holds a PhD from Brown University. So with that, take it away, Thomas.
Well, thank you so much, Hugh, for the introduction. Thanks for inviting me. Thank you all for coming. I'm really excited to be here. I think we've been trying to set this up for at least 10 years now. We always knew about QWAFAFEW. I've been at a few of those meetings in the early days. Well, I don't know if those were early days. My early days, so like 8 to 10 years ago. I don't know how long you guys have been active. But yeah, I mean, we've been talking about this for a long time. And so finally, the stars have aligned. I think COVID actually had something to do with this, where now, because it's remote, this makes it much easier. So I'm currently in Berlin. It's 1 a.m. So excuse me if I'm not totally on point. I think it'll be fine, but excuse if I'm starting to yawn. But yeah, so thanks so much for having me. And so today I'll be talking about Bayesian portfolio allocation. Before that, just a few words about PyMC Labs, which is the new thing that we're doing and which we're really excited about. So it's a Bayesian consultancy, and we are the people who have invented PyMC3. And turns out PyMC3 is being used by all kinds of different companies to solve problems from difficult to advanced. And often they have problems when they use that software and they want to take it to the next level. They want to speed up their models, or they just want a model. So sometimes they just have a concrete idea, for example, this Bayesian portfolio thing that I'm going to talk about. And so yeah, those are our clients. They range from small startups. So Everrisk is like one, it's a small risk company. For them, we built a private equity risk model. If any one of you is doing private equity, that I'd love to chat with you about that. So basically there we're using capital in and outflow, so distributions of capital calls to infer the returns of those of private equity funds, but it's a statistical model, not just really what analysts thought that would be. And so it's much more reactive and can be used for risk modeling, for example. But also bigger clients like Roche, the big pharma company, and we're building Bayesian models for all of them. I'm really proud of the team that we have assembled. You can see them. And as I said, well, we have clients in all these different domains. Go to a website if you want to learn more, or just send me an email if you'd like to work with us. Okay, so I started out in quant finance about 10 years ago. I did my PhD in neuroscience / psychology. I never heard anything about finance, really, never was interested. And then I started working for Quantopian. And that's when I really started to be like, well, I guess that's a quant hedge fund, so I better know something about finance. So I just went through that experience of learning about it. And well, obviously the first thing that you learn about is Markowitz mean variance optimization. And when I read it, I was like, well, this is amazing, right? It's just done, right? The problem is solved. You just plug all your things into this and it's proven to be optimal, the perfect portfolio to maximize the risk reward trade-off. So what else is everybody doing here? And well, Markowitz, I got the Nobel Prize for it, well deserved. It's great, but it's only optimal in theory. So when you actually then try to apply it, it totally breaks down in like ridiculous ways. So that is really the problem, right? And of course, this is nothing new. Everyone knows about this, but there are a couple of reasons for why that is the case. So the theory assumes that if you know the mean and if you know the volatility and you know the correlations, well, then that's the optimal thing to do. But obviously you don't know them, so you have to estimate them. You estimate them on data, on returns, and returns are noisy, and your estimates based on these returns are very noisy. So then you have noisy estimates of these things that you then plug into this theory that requires the true values, which you don't know. Of course, that's not going to work, right? Well, no, of course, but it just doesn't work. So we have noise in our data, but we don't quantify that, right? We just treat it as if it wasn't there. And that leads to lack of diversification. So often these portfolios are extremely tilted to just one or two assets. And well, that's when people are like, well, okay, maybe we'll find a solution. So we want our portfolio to be more balanced. So maybe we'll, I don't know, induce a cap, or there's different hacks, essentially, is what I would call them, in order to circumvent this problem and get portfolios that are not quite so undiversified. And so here, basically, there is a way to view different portfolio construction techniques under this Markowitz mean variance optimization scheme. So for example, equal weight is, well, you still do mean variance optimization, but you assume that your means and your volatilities of all your assets are equal and that there are no correlations, right? So if that is the case, if they're all equal, well, then you're just equal weight. Or inverse variance weighting, there it's basically saying, okay, well, we're using Markowitz optimization, but we're assuming that the means are equal, so and no correlation exists. So we're only taking the volatility into account, right? So if that's the only thing that goes into my optimization, well, then I get inverse variance weighting. And then, of course, there's other that exist, like Lopez-Prado's hierarchical risk parity. And really, I mean, for me, these are all things, hacks, basically, to say, well, really what we want is this, right? We want to take mean returns, volatility, and correlation into account because we know they really matter. But when we do that, the whole thing blows up. So we'll just do less, right? In order to increase robustness, we'll just estimate fewer things. And for me, inherently, that's just a very unsatisfying thing to do. And Bayesian statistics, as I will make the point, is really well suited to actually do Markowitz, but not ignore the noise, right? So here we're going to quantify that noise, and then we will get back the robustness that we're lacking. Okay, so how to think about Bayesian statistics? So if you grew up in Germany, I don't know if it's the same in the US, there's two types of kids. There's the Playmobil kids, and then there's the Lego kids. And if you're a Playmobil kid, so this basically is a prepackaged toy, right? You get it, and there's one thing you can do. It's the Rettungswagen, and you can only play with it ambulance style, right? There's nothing new you can do with it. It's a fixed constraint. Or Legos, at least back in the day, you get like just a whole assembly of blocks, and you can build one thing, but you can build all kinds of other things, right? So you had this creativity of really building the thing that you actually wanted, that toy. And well, I actually like both, but for the narrative of the story, it's better that I'm in this camp. So this is basically the Bayesian statistics. So this is like much more like frequentist statistics, where you have a certain fixed test, and that test can only do this one thing. And if it's not that, then you need different tests, right? You need a different toy. While Bayesian statistic gives you a lot of flexibility. So you can really assemble new things out of these very fundamental building blocks, and these fundamental building blocks are probability distributions. That's how we will build our models. The other important aspect of Bayesian statistics is that we can combine our expert knowledge with data. So often, especially in machine learning, right, you have to throw away your knowledge of the problem, right? You have to infer everything from data. Here we can inform the model of what we already know to make it look in the right direction. And the most important aspect is that we are not going to concern ourselves with the single most likely solution, but we're going to consider all probable solutions, right? And so, and this is where now it becomes relevant for Markowitz, is we can have, for example, if we wanted to estimate the mean and the standard deviation of a, say, return stream, right? Well, how do you do that? Simple. You just call the mean function, which computes the sample mean of your data X. So here I'm just sampling from a random distribution. You can imagine that these are stock returns, right? And that gives me a single number of returns. Or if I want the volatility, well, then I just compute the standard deviation, and that gives me another value, right? And as you can see, this value is very precise. Or rather, it attempts to be very precise, right? It's like, this is the number that is my mean. But what if instead of 50 data points, I have 500 data points? Well, it's still going to be just a single number. It doesn't convey anything about the robustness of that estimate or how much data went into making that estimate, right? The more data I have, the more I can trust this number, but the output of this is still just one number. It doesn't tell me how much I can trust it. And this is where Bayesian statistics becomes very powerful, because here we're going to model parameters, not with single numbers, but with probability distributions. And you can think about this in this term here where you have mu. So instead of just a single number, we actually have a distribution that tells me, well, most likely it's still going to be this value, right? So something like this, but also it could be 0, which is the true value here. Could also be 0.2, but very unlikely. Could also be minus 0.4, slightly more likely. So all of these values we deem plausible, right? This is the set of probable solutions given the data of what the true mean could be. And these are the values of what the true standard deviation could be, right? Given the limited data. And if I now observe more and more data, well, the space of those probable solutions will drop, right? If I have 1 million data points now out of that distribution, well, probably I'm going to be very, very clear that the true mean is 0. So I'm not going to entertain the possibility that it's minus 0.2 just because it's not compatible with the data that I've seen. But here, minus 0.2 is compatible because I've only seen 50 data points. Does that make sense? Are there any questions here? This is sort of the central theme, that if you get this, I think everything else will follow. And feel free to ask questions throughout. Feel free to interrupt. Okay, so let's take a concrete example. Here we have 16 strategies. The question is, how do we weight them? And these are actual strategies from the Quantopian platform. And as these are cumulative returns, so you can see, well, some of them just go straight up. So those are probably great strategies. Some of them go up and then they go down. So those are might be overfit strategies, who knows, right? But again, the central question is, well, do I even have enough data here? How certain am I that, for example, this is a great strategy? Could this also just be noise, right? If you simulate random walks, they often look very much like this. So how do we really assess whether something is working or not? That's the most critical question in quant finance, right? Is always like, when do we know that it's working? Is it just overfit? Is it market regime? Was it lucky? Like all these different things. We just never really know. But we can't shy away from it. The point that I'm making, we should just model the uncertainty around that and take that into account when we're building our portfolio. Okay, so I'm going to build up this plot. So far, we've just seen the data of 16 strategies. Next, we're going to build a Bayesian model that is going to tell me how, what I think basically the Sharpe ratio is, or the mean return and the volatility. So from the previous slide. And for that, I'm going to introduce Bayesian modeling in these terms here, where we will use the example of coin flipping. And we want to infer what is the probability of a coin coming up heads. So the very classic example, we start with our parameters and how those parameters give rise to data. So this is a generative approach where we say, okay, we have the coin with an unknown state, and that state is generating data, right, when I flip it. And this is how I specify my model in this forward way. So how's my data generated? And one special thing to take care of is that we always place priors on our parameters. So in this case, we have a prior on theta, which is the probability of it coming up heads. And here I'm specifying that prior to say, okay, without having seen any flips so far, I'm going to say that the probability that the coin is biased or fair is equal, right? So all of the different true probabilities of the probability coming up heads for that coin are going to be equal. And then I have a likelihood function that's going to tell me, given data x, given a theta, how likely is it to have seen that data? In this case, that's a Bernoulli distribution, and then that gives rise to my data. So this specifies the model in this generative way from the hidden unobservable thing to the data. But of course, that's not the inference problem. The inference problem is I observe data and I want to infer my unseen parameters. So let's say this is what I observe. Heads, tails, tails, heads, tails, 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 tails. Now, what is going to be my belief about plausible states of what the true probability of the coin coming up heads could be? And for that, I apply Bayes' formula, which is just flipping this around. So we're saying, okay, given data x, my likelihood, how do I update my belief in theta? So now this is theta after I have seen x, so conditioned on the data x. This is the quantity that we're interested in. And you can see that this belief distribution here now changed. So before I thought all values of the coin coming up heads are equally likely. And now I observe data, and now I'm shifting that belief around, and I think lower values, lower probabilities are more likely, given the data I've seen. So really, this is why I like Bayesian statistics, because for me, it's very intuitive. I have a belief about the world, I observe data, and then I update that belief, right? Are my hypotheses in line with the data I have seen, right? And if not, then I toss them and I entertain those those hypotheses that are still in line with the data. And then I observe more data, and then I might toss some other hypotheses that I have had. And that is the posterior, right? Is what are the plausible hypotheses? The hypothesis that the probability of heads being 100% is absolutely impossible given the data that I've seen, so I'm not going to entertain it. So I'm going to set that to 0. And so this is beautiful theory. He didn't get the Nobel Prize, but he would have deserved it. The problem is that if you do this in math, it's going to blow up very quickly. So it works in this case, but actually for other slightly more complicated problems, it blows up quickly. So if we can't really analytically derive something, well, then the next best thing is to estimate something. And this is where probabilistic programming comes in. where we can specify the model in computer code, and then we can perform inference, estimate this distribution using what I like to call the inference button, using Markov chain logic. So let's now turn to the problem of modeling financial returns. Here I have, again, my parameters, how I assume my data is distributed, and my observed data. So now, of course, I don't have coin flips. So this is not going to be the right distribution. And I could use the normal distribution, right? But as we all know, that's a pretty terrible choice because the normal distribution assumes that things like 2009 or 2020, the COVID crisis, don't happen, right? Because the normal distribution has does not allow for extreme outlier events. But the student t-distribution does. And this is the distribution that I'm going to use. So this is already that concept of, okay, I can use a normal distribution, and that's what frequentist statistics uses, or I can just flip that out because I'm in this Lego brick situation where I can just flip things and build a new model. So that's what we're going to do. And that has 3 different parameters, one for the mean, one for the volatility, and then one for the tails, how likely are extreme events. And that gives rise to my returns. So that's the model that we're going to build. Okay, so now we have data and we have a model. And to build that model, we're going to use PyMC3. So PyMC3 is one of those probabilistic programming frameworks in Python and for Python. It's open source. And you can specify whatever model you want just by putting these Lego bricks on top of each other. And it has that inference button where you can just run inference on your models and it should just work. So let's look at what that looks like in practice. If you're familiar with Python, you have to import your modules. So I'm importing PyMC3 as PM. And then I'm setting up a model context, so you can ignore this line. It's not really all that important. The model specification is what happens underneath here. So here now I'm specifying my parameters of my model. And as I just said, we want to estimate the returns using a student t-distribution, which has 3 parameters. Those are these 3. And then I'm going to define priors for them. So the mean returns can be positive and negative. So I'm choosing normal distribution. The first argument is just the name of that distribution and then the parameters of that distribution. So it's going to be centered around 0, which means my returns are probably going to be close to 0. The mean of my returns are running close to 0 with a small standard deviation. Then what is my belief in the volatility? What are plausible scenarios for volatilities? And if I ask you, basically, this is just me asking you, okay, what kind of volatilities of trading strategies have you seen in the past? Probably something like ranging from 1% annually to 20% annually, something like that. So this is the prior, right? We don't know for this particular strategy, but you've all seen hundreds of strategies and you know what type of volatility levels those have. So this is what we're trying to specify. And this is what I'm doing with the half normal distribution because volatility is not going to be minus 5%, right? So it's only positive. So the half normal distribution only allows for positive values, no negative, with a small standard deviation. And then another prior just also for the how much there's in the tails. And then I have to specify my likelihood function. And here, as I said, I'm using a student t-distribution. I'm again giving it a name. And then here is where I'm plugging this together with these parameters up here. So my mu of that student t-distribution is going to be this parameter that I want to infer. The lambda is going to be that parameter that I want to infer. And the new parameter is going to be the tail parameter that I want to infer. And here now, I'm actually observing this, right? So this is the likelihood function. So I have to pass in as a keyword argument to observed the returns, which is just an array of the daily returns. So that's it, right? So this specifies a very simple but complete statistical model that allows me to estimate these 3 parameters for my returns. So this is just the model specification. As I said, this is not estimating anything. So for that, we have to call the sample function. So there's that inference button where now we're estimating those posterior distributions or fit these parameters to data using the sample function. And then we get that posterior distribution. So here now is the, basically for those strategies, now I can compute, okay, what's the probability that my mean return is 0? And so this is really cool because now, before I couldn't do this, right? Before I would just get, let's say I would compute a Sharpe ratio and it would be 0.5, right? But then again, that's just a point estimate. So what is the probability that that point estimate is larger than 0? You don't know, it's just 0.5. Here now we can actually, with that posterior distribution, say, what is the probability that the Sharpe ratio is larger than 0, and then get all these different strategies. So this is now fitting that model to those 16 strategies that I had before. Right, so I'm running the model on all these 16 return streams. I'm estimating what the mean is, the mean distribution, and then I'm just saying, okay, what is the probability that the mean is larger than 0? And for some strategies, right, so for this one, the probability that the mean is larger than 0 is very high, right? Or for this one, it's also very high that that mean is 0. For a strategy like this, the probability that 0 is probably going to be larger than 0 is probably going to be 50-50. So that is what I'm plotting here, is that probability estimate. So now I can actually say, okay, what is the risk that I'm taking on when I am investing in these strategies? Right. Okay, so that is the main points that I wanted to cover. We can take this further, but for that I would refer to a blog post where, so this is already useful, right? So this you can say, okay, now I have an actual sense of the probability or the risk that I'm taking on when I would deploy such a strategy. So this is the problem we had at Quantopian. You can take this one step further, but I won't go into too much detail on this. So just high level is basically using Bayesian decision making, where now we are turning to the problem of building a portfolio out of this. And we can do this by projecting my returns into the future and basically having a scenario analysis. So we're generating all kinds of different plausible scenarios into the future. This is what I'm doing here. So here I'm generating future returns from my model, and then I'm using those future returns to build a portfolio that will be optimal across all these different scenarios that I've generated. So have basically I can turn my model into a data generator, into a scenario generator, and then I can optimize across these different scenarios and get the portfolio that is optimal, not just for the most likely case, but across all different cases. And that's really the key to solving Markowitz. So we can do Markowitz optimization, right? But we're not going to do Markowitz just on the most single likely scenario. We're going to do Markowitz across all different scenarios, right? So we're basically solving Markowitz many times, taking different plausible scenarios into account. And that is what gets us robustness back. Yeah, so there's just some more detail. I'm going to share those slides and then you can look. But yeah, so then we get weights back. And these weights now balance all kinds of different things, right? So they take correlations into account. They take the mean and the volatility into account. So this is full Markowitz. But it's not going to be extremely biased, right? So if I would just do this for with point estimates, right? Not the forecast, not the scenarios that I have. Then I would just assign everything to a single algorithm because that happened to have the best risk-reward trade-off. But here now I actually get the trade-off between, well, some of them are just not good, some of them are better, but we're still hedging our bets and taking into account that even though this strategy called Bender here is the most likely to be the highest winner, it's also possible that we have estimation noise and that's actually not that good as the data would have suggested. So we're taking this into account, and that's why we're not giving everything just to this one strategy. Yeah, and the full model that we actually built was way more complicated. So this allowed for changes in volatility, changes in the mean, and the correlations as well. Yeah, so the benefits of this approach are it's much more robust. because we're using posterior distributions rather than point estimates. So that is a point that came across. And things like different length track records automatically handled. So this is often a problem we had at Quantopian, but it's really universal, right? So you have two asset managers, and one asset manager has a Sharpe ratio of 2 for 3 months, and the other one has a Sharpe ratio of 0.5 over 3 years. Which one of those do you give your money to, and how much? Well, most likely, if you're making a discretionary choice, you would give it more to the person who has a Sharpe rate of 0.5 over 3 years, because 3 months just isn't really a lot, right? A Sharpe rate of 2 could really just be luck. If you're using point estimates, well, then you would give everything to the guy with a Sharpe ratio of 2, because that is that number, right? 2 is larger than 0.5, and you don't have injected that information that it was estimated on very little data, and it's going to be very noisy. But if we were to use Bayesian statistics, you would say, well, for that Sharpe ratio 2, I would imagine that there's many different plausible Sharpe ratios that could explain that track record, right? Many potential true scenarios. So this is automatically taken into account here, and this was very important for us at Quantopian. And then we can improve that model as well, including expert information, like maybe we know a certain manager really well. We want to tilt the model towards that side, or improve the model in all kinds of other ways, and still just get better portfolio construction. So with that, thank you so much. This is the blog post that outlines this in much more detail as well, on an example of supply chain. But yeah, if there's any questions, I'm really happy to answer them.
Hey, Thomas, I have a question.
Sure.
This is Anish. So I was wondering, how do you handle side information? This is things like implied volatility, and I have this question for things that I'm working on. So I definitely appreciate any guidance on that. And then you'll have implied volatility, or you might have news, or you constantly have these news sources of information that you want to attach to your model that you might not have had in the past. And how would you set that up?
Yeah, that's a good question. So I think, so it really depends on how you think that influences certain things. So let's say you have information that certain news sources would affect a certain type of investment more than another type. So then you could choose a prior that says, okay, well, if this thing has a bigger influence on this other thing, right? So you can strengthen that connection basically between them, just by setting a prior, which is just expert knowledge. So you know that this is the case. And then you can refine that further by learning also from data. But yeah, so this is something that we include in the model structure. So maybe you have some factor matrix, right? Or however you structure this, and that would just be, adding more model structure.
And so say something like implied volatility. If you're predicting returns and volatility, and so you have some historic volatility, and then you have implied, which is probably better than the history, and how can you say a little how you might set that up? So meaning that the information it's so strongly maps to something, it's not this diffuse side information, but it's saying I'm giving you a much better estimate of your volatility than the history.
Right. So in that case, I think you would just say in the model, instead of this being your estimate of volatility, right, that goes into the likelihood of the returns, this would be fixed.
So you put it into the prior somehow.
Yeah, exactly. So
okay.
You wouldn't just estimate this from the returns, but this would be coming from somewhere else. Yeah, exactly. So maybe volatility is not just a prior, but actually is a function of implied volatility.
Okay. And is there a way to keep the same prior, but then to have the information be it's something like it's in your X, something like that? Can you think of how you might set that up?
So I thing.
Without changing the prior. So just if it may be the way to go is to change the prior. I just want to pick your brain on it a little bit because I'm working on this very thing right now. So
Yeah.
I appreciate
So
it.
would you want to fix the volatility and not estimate it at all, or would you want to estimate it but be very informed by it?
I think that what I want is say I have all stocks have the same, some sort of generic prior on the volatility, and then I observe some things happening. I observe some returns, and that gives me some information about the volatility. But then I'm also getting this side information of implied volatility, and I want to use. I ideally I like to set it up where I have the same prior, but I'm just this side information is sort of like the X, and then I want to update that way. Yeah.
So I think what I would do in that case is I would say, so volatility still enters here, but volatility also enters into a second likelihood function, right?
Yeah.
So volatility is not only estimated by returns, but also by the applied volatility. So
okay, yes.
you still have the same prior, but now there's two sources of information for estimating it. And if one of those sources has more information, automatically that will have a bigger influence on the final estimate of volatility than the very noisy returns. So that's probably the way I would do it.
I got it. I'll just repeat it back. So you just say that the implied volatility is some sort of observation of the underlying volatility, just like the X is the observation of this whole process.
Exactly.
Yeah. Okay. Thanks.
Thomas, this is Larry. On a lot of your graphs there, you had a y-axis with names, and I was just wondering what they all meant.
You mean this one?
Yeah, this one, yeah.
So yeah, I actually don't even remember why, but these different strategies, I gave them names from Futurama.
From Futurama. I wonder why. They sound so familiar.
Exactly. Yeah. So each of those, it's too small for you to see here, but yeah, each of those is the name of that strategy. So I just had to pick some naming scheme. So that's what I came up with, Futurama names. So for example, here we have Hermes, right?
Yeah.
Favorite characters, and then
Bender should have been the giveaway.
Yes, and then we have
Got there.
Hermes over here. So this one looks
Hermes,
really good.
Yes.
Yeah, exactly. Yeah, Bender obviously is also a great strategy.
Joey's mouse pad. I don't think that fits in, but Dr. Goldberg is there. Yeah. All right, Fry, Leela.
We've got them all
Tons
here.
Tons of butt. Wow.
Yeah. I'm glad you caught that. Yeah.
I had another question for you. So the PYMC, that's the routine?
PyMC3, yeah.
Yeah, Pi. So you demonstrated one application of it. I'm guessing that's got like a bazillion different things you could do with it. And any particular thing that you read or when you were trying to use it for the first time that you found helped you get the most out of it?
Yeah, so definitely there's like a huge variety of models you can build. There's a few things that you can't do with it. So you can do machine learning with it and deep learning with it. You can build linear regression models. You can build time series models. The thing that really converted me was hierarchical models. So often when you have nested data, for example, here we have 16 strategies, right? And they all have certain similarities, right? They were all written on Quantopian. They're all quant strategies, right? And it's reasonable. So basically what I showed you so far is we take that model that I showed and we estimate it 16 times for 16 different strategies. But we're throwing away information, right? Because we know that these strategies all have some similarities. Like if the means of them will be somewhere in the same range, right? So that I can use to inform my prior. And I can do that with a hierarchical model. So that is one model that models all 16 return streams simultaneously, but also models the differences and the similarities at the same time. And this type of nested structure happens in a lot of problems, and a hierarchical model allows it to estimate that. if you go to my blog, there's a post I have on hierarchical models that explains that. But yeah, this idea of estimating everything at the same time and estimating the shared information we get from each individual strategy is extremely powerful. And Bayesian statistics is one of the few things that allows you to do that.
Yeah, the hierarchical model, obviously, if you have a strong prior, I guess, you know, that something, everything will follow from some type of variable or something, and then the randomness occurs later. But you know, you're saying it's either going to be a good day in the market or a bad day in the market, and then you split it there, and then you sort of go off on the.
Yeah, exactly.
So you can plug this in. So there's I'm trying to come up to speed on some of the machine learning stuff that you can do in Python, because I guess it's all accessible ultimately in R, because you can call the Python from R. But I was mentoring some kids, and we did some work on sector rotation, and that was a paper that I presented back in September, which I still owe QWAFAFEW, and we're finally getting it done, and it'll be posted at some point or another. But when we tried to do the same problem with using the standard machine learning stuff, we didn't get anywhere. It just it seemed like we were using a Markov switching model, and it was just pretty straightforward to pick out the the high states and the low states much easier than it didn't seem like we could pick anything up. So I'm wondering if somehow if you included a prior on, okay, the market will go up X% of the time or down X% of the time. So would you think about incorporating that sort of thing in this approach?
Yes, definitely. So that's exactly how I think about priors, is they allow you to tell the model where to look.
Got it.
And so yeah, like with machine learning, especially in quant finance, it often doesn't work because there's so much noise, so little signal, and then you have non-stationarity, right? So it's just really difficult. And that's where you can tell the model where to look. So for example, if you know, I know that I have a low and a high state in my hidden Markov model, and I sort of know already what the low state looks like and how often it occurs and what the probability is of switching, all of that can be already incorporated in the model prior to really you only have to learn where you can use very few data points to learn the same thing than before. And that's really powerful. So whenever you have little data and enough knowledge ahead of time, Bayesian statistics is going to be extremely powerful because other approaches just don't work in those scenarios. And there is a package that we just released called PyMC3 HMM. So that allows you to build hidden Markov models in PyMC3.
Oh, how convenient. Could you send me a link on that, or I don't know if we can post it or something of them.
Yeah, absolutely. Let me.
Yeah. I'm Larry_Pullman at yahoo.com.
I'll post it in the chat here. Will that work for you?
Sure. Yeah.
Cool. So the first thing I'm posting is.
I'll put it in there now.
That's the chat.
Oops. Okay, thank you. Appreciate it. I'm wondering, if like an academic association, where they can get funding and they in turn fund that. I mean, because in the old days you didn't even have classes online, and I forget the guy who started doing all those things, and now everybody's got online. And Shri, I think, is the best online. Let's just make that clear. He's got the best online university. But I was just wondering if you get funding, I guess I should come back to you later on that and say, okay, suppose you found somebody who give you $1 million, 10 million, whatever it is. What would it take to get it started again? And because I got to imagine that there are a lot of people out there would still love to have it. So.
Yeah, no, absolutely. I mean, I'd love to see that. So yeah, if you get those millions, then then we can talk.
Okay, well, let me check and see what's in my bank account right now.
He's still on getting the millions.
Yeah. Millions make things possible. That's usually how this works.
All right, thanks, Thomas. Thanks for the links.
You're welcome. Cool. If there's no other questions.
Any more questions?
Well, thanks everybody. This was fun.
Thank you for coming back after 10 years of trying to get you to speak.
Yes.
Thanks so much for being flexible and waking up at night, midnight. We woke you
My
up at
pleasure.
midnight.
Yeah, this was fun. This was definitely worthwhile. So yeah, thanks everyone for coming out, and hope to see you around. Bye.
Absolutely.
Bye-bye.
All right, good.
Good night.
Thank
Bye-bye.
you.